All right. My name is Chris Campbell. I'm a practicing CPA, and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping you out of jail. So today I wanted to talk about state income tax and when taxes apply to you for different states. So question was raised recently. I actually started recently working with direct-to-consumer e-commerce brand. They're relatively small at the moment, and they're in one location and they're shipping items all over the country. So with that said, the question arose is, what is my state income tax obligation to those states that I'm shipping to, at least for those states that do have state income tax, right? Not every state has them. And understand this is different from your sales tax obligation. So there's two different taxes that I'm referring to: your sales tax and your actual state income tax. I had done a video on this previously about sales tax due to each state. And essentially, you have different thresholds. Every state has its own threshold as far as when you need to pay and report sales tax. So usually it's a dollar amount of sales that you made in that state or number of transactions over the course of the year. Every state is different. I'm not going to get too far into that right now, but every state is different. You can look that up and determine if you have to tack on sales tax to that state. But this discussion was more about the actual state income tax. And there's a couple rules that you have to take into consideration to determine if your e-commerce brand, or maybe you provide service and you service people all over the country. The question is, do you owe state income tax? In this particular instance, because my particular client in this case is selling a physical product, and there is a law in the books called the Interstate Income Act. Essentially, in summary, what the law states, it exempts people who sell physical products from paying state income tax as long as your only presence in the state is to solicit and process sales orders. That's your only activity in that state. Then if you're selling products, understand it's limited to products, not services. If you're selling products, then you don't have to worry about paying state income tax in that state. Now, a couple of things here is that it's stated that if your only activity is soliciting and processing sales, and as of recent, and because of the age of the internet and with the explosion of e-commerce, you have a number of states now that are defining or drawing more strict lines as far as what that activity of soliciting and processing sales orders are, and really want to define that, because if you're doing what they deem beyond that, then that state can reach back to say that you owe income tax. Now, every state has its own definition. I was actually recently looking at the California definition. I think they're a state that's pretty strict as far as what those activities are, and they've actually outlined and defined certain things that what would be deemed activities beyond soliciting sales. So, for example, if you provide support to a customer after a sale, that is deemed an activity outside of actual sales. Technical support, customer support. If you start selling warranties online with this particular customer after the fact, that is considered activities outside of soliciting the sale. And also, for all intents and purposes, if the customer is using your website and they're in a state other than where you're located, they are considered conducting that activity in the state that they are in. So a lot of states is that if you start initiating sales beyond the actual processing of the order, then you're deemed to be doing more than soliciting sales. So if you're offering customer support and you do it by email or you do it by chat, that is considered an activity done in that state. So again, some states are stricter than others, but if you're literally looking to tamp down what you may owe to these different states, you really have to be careful about even some of the activities beyond the sale or in addition to the sale, because these states could come after you. So you really have to be careful about that. Now, also understand that these things that I had discussed, it's strictly limited to products. Now, with products and physical and tangible products that one may be selling. It's a whole different ballgame if you're offering services. If you're offering services, you are considered having done a sale in that state if the person receiving or benefiting from the services are in that state. So technically speaking, if you provide legal services, you're in one state and your client is in another state, and you're deemed to have done a sale in the state that client is in, even though you might have necessarily never stepped foot in that state. So now, as far as the accountability and being able to tax those services, there is a formula that most states follow to determine the ability to tax. I don't know the exact formula is up here, but it's a combination, and every state is different, but it's usually a formula that combines sales in that state, which again is based upon who receives the benefit, or where the person is that receives the benefit of that service. Payroll, and do you have employees in that state? So even if they're doing the work from home or telecommuting, and they're not necessarily coming into office, but if that person is located in that state, then that's a payroll considered for that state. And that also factors into the apportionment bill on how much income to be allocated to that state. And then the third part is the buildings. So do you have any property in those states? So if you have offices, warehouses, any form of operation, that you have facilities that you either own or lease. So it's not tied to just specifically if you own. If you lease as well, you have property in that state, that factors into the apportionment as well. So usually most states have a formula that combine the three to determine how much of your income should be allocated to that state. But again, none of this trumps if you're selling physical products, but again, strictly soliciting and selling products. So the Interstate Income Act is a federal law, so none of the states can trump that. But again, states are starting to play games with what they consider just soliciting and sales activity. So you have to be very careful. So that's a quick rundown. And if you provide services in different states, or if you're selling products in different states, you just may want to take these into account, keep in mind, just so that you may be able to reduce your tax liability with these different states, and also just creating a mess for you as far as when it comes to tax time, especially if you're offering your products and services throughout the country. Just from the way that you may have a few things set up, you may cause yourself to have tremendous liability in these states, but also obviously a ton of or headache of having to file taxes in a bunch of states. So take heed to those factors and watch those activities very closely, and you should be able to control your tax liability. So I hope this was helpful. If you have any questions about this topic or any other tax accounting related questions, feel free to reach out. I'm happy to help. All right, that's all for now, and I'll talk to you in the next.